Good morning, everybody. Thank you for joining us on our webinar today on Business Support webinar on Cashflow. It's the fourth one in our series of business support webinars with Nordens. Before we get going, I just want to run through some introductions because we've got some new faces today. So I'm Greg Guilford, I'm the CEO of HR Solutions. We've got Joe Sword, who's the head of strategic business planning at Nordens, and we've also got Darren Han today, who's the head of corporate finance at Nordens as well. Atim Adam is our digital marketing exec, and she'll be in the background helping support with any technical questions that you have. Those of you who attended these webinars before know that we do like to encourage interaction, so we do want you to ask as many questions as possible, but you will all be on mute at the moment. So in order to ask your question, you note that you've got the GoToWebinar panel on your screen, on your desktop somewhere. It should look something like that, and there's a tab that says questions. So simply, if you have a question that you want to ask either Joe or Darren, then please just type your question in the panel, and we will ask the relevant question to either Darren or Joe at the end of their session. So just put as many questions as you wish as you go through. No question is stupid, and we'll aim to answer as many as we can. As mentioned, it is interactive, so we will have a couple of polls throughout the webinar as well. So please answer as many of those as you can, and Joe will sort of analyse that and present some answers to the poll responses as well. So make sure you've got your notebook ready to take down some notes. There's lots of information that Joe's going to be sharing with you all in terms of Cashflow. So as I mentioned, this one's on Cashflow, and I'm now going to pass you over to Joe, who's going to run the rest of the webinar.
Brilliant, thanks Greg. Hi everyone. So yeah, as Greg mentioned, my name's Joe Sword. I'm the Strategic Consultancy Director at Nordens. My colleague Darren's with me today, Head of Corporate Finance, and it'll be really relevant for Darren to be here because we're going to be looking at Cashflow today. So to give a little bit more background about ourselves, we've worked with thousands of business owners over the years, and because of this, we believe that we have the ability to support and help many of you move your business to the next level. And we want to make this available to as many people as possible. So during lockdown, we were having a sort of putting our heads together, and we were looking at how we can make this more accessible. So what we've done is we've created our bi-weekly online advisory program, which is based around our Wheel of Success. And on our wheel, there are 7 segments, and the webinar series is sort of focused around each of them in turn. And we strongly believe that success in these 7 areas will lead you to overall business success. And on the flip side, when you look at businesses that are struggling or failing or perhaps not doing as well as they could do, they're generally attributed to one of those areas or perhaps more. So the 7 areas we are going to look at in the series are your why, your vision and your goals, which we covered on the first one, your sales and marketing, which we covered a couple of weeks back, mindset that we covered last week, cash flow that we're going to look at today, systems and processes, profitability, and team and culture. And we feel that our online program helps with some of the biggest headaches business owners face, namely advice and direction, different perspectives and accountability. And based on this, the program will give you bespoke advice from our team of consultants and special industry expert guests, access to a group of like-minded business owners from a variety of sectors to give you different thoughts and perspectives while also enhancing your support network. And over the years, we've realized that having someone offer their thoughts or perspectives from that impartial or perhaps unemotional point of view is one of the most underrated success factors, because we see it quite a lot where business owners are kind of ingrained, so deeply involved in the day-to-day, it kind of clouds their judgment and their thinking perhaps in certain areas. So having someone who doesn't have that level of emotional attachment coming in and perhaps offering different thoughts from a different sort of angle is really, really valuable. And you'll also have a team to hold you accountable, proven to help you get results quicker. With a strong focus on goals and actions, it ensures that you don't just build momentum, but you maintain it. And these ingredients we found are key elements for success, and we've got a growing number of case studies from businesses and their owners who are thriving because of the program. And it's actually proven by working with others in a group setting like this can increase your success rate by up to 200%. So that gives a little bit of insight into the program and how we frame this webinar series and where it's sort of came from. Now I'd like to move on to sort of what we're going to cover today. So like I mentioned, we're going to look at our cash flow, and while today, as Greg mentioned, we're looking to make it interactive, We're not going to be able to completely replicate how interactive our online program is, but because we've got the polling system and we've got the opportunity for you to ask questions, we'll still be able to have that degree of interactiveness. So how it's going to work is I'm going to outline the area, give you a few thoughts from our perspective, and then there'll be some polls for you to answer with a few questions. The answers will be anonymous, but what it will do is it will allow us to gauge where the majority of you listening in today are positioned on each of the areas. And like we've mentioned, if you have any problems or questions, just pop a message in the chat box, give us a signal, and we'll do our best to help. So moving into cash flow, I came across a stat recently that said 82% of small businesses fail due to cash flow. And a few triggers of problems include not being diversified enough in your customer base. So you're relying on too few customers. If there's an issue with that customer, it really negatively impacts your business. Relying on your big customers, following on from that, to pay their large bills to get you through tough times. So not just relying on too few customers, relying on too few invoices, so to speak, where the invoices are so big, they really have a massive impact on your business. You have too many receivables or debtors and you're just not being paid steadily enough. You're regularly in your overdraft. We've seen it quite a lot where business owners actually start cutting back on their own earnings from their companies. Cutting other essential costs is another trigger. Receiving regular payment demands from your suppliers. A poor or negative working capital cycle. You don't get discounts when you're paying your bills. You have a lot of short-term debt and have really high stock levels or really poor stock management system. But I suppose the biggest problem of all is not actually being aware of your current and future cash position in the first place. And that's why anyone that's listened to me before, we place such a big emphasis on having a cash flow forecast. So we've mentioned that cash is so important and the phrase cash is king more than ever in this time is so relevant. And many successful and even profitable businesses have actually struggled or gone bust because they didn't pay enough attention to those cash pinch points or were just unable to manage their cash properly. So when I say pinch points, what I'm getting at is pinch points are often based on the economic factors, and it's really the time you're taken outside of your comfort zone in respect of your cash buffer. So for example, if you're aiming for a cash balance in your business bank account of 3 times your monthly overheads as a buffer that you feel you're comfortable with and you can manage through, and your forecasts that you've prepared actually show that in 2 months' time you're only going to have 1.5 times cover, you have a pinch point. And some businesses do this differently. Some businesses will sail more close to the wind, so to speak, and they may deem a pinch point as the point in which they actually reach their overdraft level. But every business is different, and the point really is to look at your pinch point is that time that you become outside your comfort zone. And it's not to say that businesses shouldn't have pinch points. They are expected as you look to grow, and they shouldn't be a reason to stunt your growth. But it's where proper planning comes in to determine the appropriate level of risk around the decision and your ability to trade through the pinch, so to speak, or whether you need to look at things like raising some short-term capital to support you there. What we always recommend is to plan as early as you can, which is partly why we emphasize long-term thinking, to move away from just complete short-term focus and ensure your decisions are well-rounded, not just for now, but for the future. It's also really important in our eyes that you create more than one different option and look at scenario modeling or scenario-based forecasts where possible, because that will allow you to anticipate and resolve future issues, regardless of whether they're positive or negative. So having that robust cash flow forecast and considering your overall cash management systems and processes are really essential for every successful business. So I'd like to jump into a poll now. The first poll that we'd like to open up is around how you forecast your cash in your business. So do you have, like we mentioned, a scenario-based forecasting model in place for your cash where you look at multiple different options? Do you have a cash flow model in place, but you don't really have any scenarios? It's quite rigid. It's just sort of one scenario. Do you have a simple-based cash flow forecast model, but you don't really use it very often? Or do you just literally don't have a cash flow forecast at the minute? So yeah, give you a minute or so, and then I think Greg will share the results to see where everyone's positioned out of those options, because it will be quite telling where you perhaps need to apply a bit more focus, perhaps.
Okay, about 60% of you have completed so far. Just give it a few more seconds for the rest of you to make your choice.
And I think the important thing is just be brutally honest. You know, there's always room for every business to improve. So if you feel a bit uncomfortable that you don't have a cash flow forecast, put it on there and let's just see. Okay, so there's quite a variety. So 43% of people have that scenario-based cash flow model in place. Fantastic, that's brilliant. It'd be interested to hear what that actually tells you and how that helps you make decisions, because the businesses we've worked with that have that sort of modelling in place undoubtedly make much better decisions, and they've attested to that fact. So those of you, the 14% that have that cash flow model in place, you have a cash flow forecast, but you don't really scenario analyze it. That's the next step for you guys. I think it's looking at, okay, we've got our sort of projected scenario, but what happens if something changes? What happens if this doesn't happen as quickly or quicker than we thought it would? How does that affect everything? And it's a really, really useful tool to look at. And I suppose the same sort of principle applies to the 29% of you that have said that you do have a cash flow model, but you don't really use it as often as you possibly could. I think it's about building that habit and ingraining it within your normal sort of day-to-day running of your business. Not to say that you have to look at it on a daily basis, but some businesses would. But I think the main thing is that you're using it to the best of its ability as a tool to help you make decisions. And I think, referring back to our original session on why, vision and goals, I think if you can frame it back from your original purpose, your real long-term vision, you can then use this cash flow as a gauge, or your forecast as a gauge to track against how you're progressing towards that vision. So yeah, I think there's a little next step that you can make there. And for those of you that don't really have a cash flow forecast, look, everyone has to start somewhere. You know, I mean, we've worked with plenty of business owners who have never put a cash flow forecast together and then looked back and gave us feedback that it was actually the best thing they've ever done. We have templates that we can share with you to help get you started there. But I would really strongly emphasize that if you aren't doing some form of cash flow forecasting, you really are at a disadvantage to those businesses that are, because it just limits your ability to make good quality decisions. And I do appreciate right now, the pandemic, the last year and a bit, has been really difficult to forecast anything, but you have to start somewhere. And you're not likely to get it spot on, but I think at least if you start somewhere, you can then start gauging how well you're predicting things. So yeah, that's really interesting to see. There's quite a variety of people on the call today. I'd like to jump straight into the next poll, because following on from that, this next question kind of follows on really nicely. How frequently do you actually report on your cash flow? So not necessarily the forecasting element, but how frequently do you actually report on your cash and how you're managing your cash in your business? So the options are obviously weekly or more frequently, monthly, quarterly, or do you actually report less frequently on your cash than on a quarterly basis? So again, a few seconds or so to jot down your thoughts on that one, and then we can see where everyone is.
Okay, so about 50% have voted, so we'll just give it a few more seconds before we share the results. Okay, I'm going to close the poll.
Okay, so that's interesting. So I think it depends on the degree of reporting, really, about what the ideal scenario is. I think weekly or more frequently. I think the headline numbers are important. I definitely think a weekly sort of cash rec for the businesses that are growing, or cash is quite sort of seasonal and volatile. I think it's really important to stay on top of it. Some businesses can get by having sort of detailed cash reports on a monthly basis, but I'd probably look to be having a gauge on the key numbers perhaps a little bit more frequently. Nobody's actually said quarterly, and a few people listening in, 20%, have said longer. So I think if you're reporting longer than on a quarterly basis on your cash flow, you're probably potentially heading towards pitfalls that you may be able to avoid if you had more up-to-date information. So I'd look to sort of take that away from today and see if there's a way that you can get your reporting a bit more frequently on your cash flow, because I think it is really important as a decision-making tool. So like we sort of said, the businesses who manage their cash well are left with the most options and therefore the most opportunities to take their business forward, which will also help them diversify and self-preservate where necessary. So I think things like understanding trends and making the most of your data, such as which customers are generally paying you late, which suppliers are more accommodating when it comes to payments, All of these things help you build good quality forecasts and add further clarity and help you when you're making those predictions. Another thing that's really important is having that process for actually vetting your customers before you take them on, so you're actually better able to predict the issues you may have down the line. One good way to do this is to actually run a credit check on your customers. It's obviously dependent on whether you're doing business to business or business to consumer about which is easier to do, because it's not always as easy to run credit checks on individuals. But I think it's something you should definitely do regularly on your own business too. Darren may touch upon the areas of the credit searches that can actually impact your ability to raise finance in the future too. So I think what we've sort of covered so far, it all sounds relatively simple, and in principle it actually is, but there are a significant number of businesses out there who really get this fundamentally wrong and really don't pay enough attention to their short and longer term cash outlook. And the businesses that struggle often have that little or no reporting function in or around their cash flow, which can often result, we've seen it so often, where an issue magnifies and then desperation sets in. And by that point, it's often very difficult to get yourself out of the hole by raising finance. So it just becomes a bit of a recipe for disaster, so to speak. So I think plan early and give yourself as much opportunities as possible. Another thing for a lot of businesses is having a good grasp of your working capital cycle. And this will be more relevant for businesses that generally hold stock than other businesses, but it's still an important principle. So your working capital cycle, in essence, is the number of days shortfall between purchasing or creating a good and actually receiving full payment from your customer. So, for example, if you are a business that holds stock and you have your product in stock for an average of, say, 20 days, once you make a sale, it takes your customer 20 days on average to pay, and you reduce the cycle by taking 30 days to pay your suppliers. So, on average, your working capital cycle is 10 days. So, being clear on that cycle and how easy you are to manage and how able you are to manage that is a really important metric, because as you look to grow your business, any little cracks that you've got in that working capital cycle will only increase your cash pinch as we go along. So I think being aware of your working capital cycle, especially if you're a business that holds stock, is really important. So we've touched on sort of your customers and getting them to pay on time, and there's a few simple things you can actually put in place to help you in that way. One thing that I think is really relevant nowadays is to explore and embrace technology. There is software out there, apps and various other areas that you can look at in terms of software that will help you in your ability to get money in from your customers. You know, you can automatically generate your invoices, you can automatically generate your chases nowadays, and it just makes it so much easier for you as a business owner to actually take that burden away from you and make it automated. If your job is project-based, over a long period, push for upfront payments wherever possible to at least cover your costs, which reduce your risk. I know it's not as easy as what I'm saying. I know it's easier said than done in practice, but I think wherever possible, if you can get upfront payments to, again, at least cover those initial costs, you're already reducing your risk significantly, because we've seen it so often with businesses that win a big project and they see the fantastic work they've done to achieve the project, and then realise that, you know what, we're going to have to somehow fund this project for the first 60 days because we won't get our first pay period until then. If you can work with your customers and help address that pinch, it will make a massive difference. Another really simple one is actually just sending your invoices on time. We're amazed at how many businesses we've worked with over the years where actually sending the invoices out to the customer is often delayed because there's so many other things to do. But if you don't invoice on time, it's unlikely you're going to get paid quickly enough that you're just dragging out your payment cycle unnecessarily. So make sure all your invoices get sent on time. Alongside that, make sure your terms are crystal clear and specify a date. So we've seen a bit of a psychological, I read a piece about the psychology of actually putting due dates in there. So saying things like due October the 30th, 2021 is far more impactful than payable in 30 days. So it's just a little thing, but actually specifying the date can often allow you to get your money in sooner than just saying something like payable within 30 days. Emphasising the benefits of prompt payment, reminding customers that timeliness is the key to maintaining a good credit rating from their perspective as well. So if they're paying their suppliers, i.e. yourself, quicker, they're more likely to be able to back up their own good credit rating. And off the back of that, ensuring you have that solid credit control process. We're going to look at systems and processes in the following webinar, but I think ensuring you have that simple roadmap of how you deal with your credit control, because so often that is left where it's just left to build up and build up and build up and becomes a huge problem. And don't be afraid to work with a collection agency for those debts where they're literally crossing the line of your patience, where you've done everything you can to chase fairly and they're just not buying. Work with collection agencies, because what they can do is sometimes send a sort of letter before action, a legal letter, and that's sometimes all it takes for you to get your money, and that doesn't cost a lot either. So I'd like to jump into another poll now, and that's around your customer vetting and your credit control procedures. I'd just like you to rate them on the options that we've got here. So extremely strong, and in our mind, that's kind of a fully systemized and regularly tested vetting and credit control procedure. Good to strong, where you've got it mostly systemized, but you only test it occasionally perhaps. You're just honest and you're saying it could be better, or you literally do not have any formal procedures for vetting customers, and your credit control procedure is probably vague and sporadic at best. So if you can just grade yourself as you are now, it'd be interesting to see where everyone's positioned.
Okay, about 60% have completed, so just give it a few more seconds before we close the poll.
Okay, so it's good to see that, well, everyone has some form of procedure for vetting customers in place, but 40% of you have said that it could be better. So I think that's an indication there, by just answering that there are potentially some actions that you can take away today and see if you can strengthen that. I mean, just making sure you have it fully systemized, and ideally giving someone else the control of it if possible. It will allow another person to be brought into the whole idea behind it. But I think first things first, make sure you've got that clear system in place for your credit control and your customer vetting, because it will really help you out. And the people that are saying that it's good to strong, perhaps you're just not testing it often enough, and we'll cover the benefits of testing on our systems and processes webinar that will be upcoming in a couple of weeks' time. But I think ultimately, if you're not testing it, you might run the risk of doing things that you don't really need to do anymore, or you're missing opportunities to actually improve your own processes. So on the whole, sounds pretty okay, but there seems to be a bit of room for improvement there. And what you see quite a lot is you see business owners with that really good growth plan and a cash need, such as an acquisition or equipment purchase, but actually put it off and wait for more cash to build up as they're too close to their pinch points. But what this actually does is it starts to stunt their growth. And there are really a lot of funding and finance options out there for businesses, and I'll bring Darren in very shortly to discuss them in more detail. But the key thing is, we're not looking and encouraging to take finance for the sake of it, but as long as you've thought it all through and you've actually forecasted well, you will be able to explore different finance options that suit you well and will allow you to continue on your growth path and not be held back. So just one last poll before we're going to sort of bring Darren in, is just about how many of you out there have been slowed down in your pursuit of your goals due to what you would class as a lack of cash. So I'd be keen to see whether you regularly feel that way, whether that's an occasional issue, a rare issue, or you've never ever felt slowed down due to lack of cash. So yeah, again, we'll give a minute or so for you to put your thoughts down onto that one, and we can see where everyone's standing in respect of their feeling slowed down because they just don't have the cash to pursue the goals that they want.
Okay, about 70% have completed, so I'll just give it a couple more seconds.
Okay, so again, nobody feels they're regularly slowed down due to lack of cash, which suggests you're managing your cash fairly well. And people have said, no one has also said that they've never been slowed down. So occasionally and rarely, it'd be interesting to see a little bit more information about it. I do appreciate it's only this poll and it's really headline, but I think it's about drilling down to find out what is perhaps slowing you down and why, and have you really explored all the finance options that are available to you? And I think that's where perhaps if you are questioning that, you can maybe ask Darren a question and he can maybe help you specifically with things that you're facing. But I think once you're consistently above that cash buffer that we were talking about, you really need to be asking yourself, what can you do to make your cash work better for you? Is that an investment in equipment, acquiring a competitor perhaps, or any other growth plans, even a personal investment as a business owner? But one thing we know for sure, that in the current climate, you're not going to get a lot in the way of interest. So you need to really make any surplus that you have work for you in the most efficient way possible. And this is, again, where your forecasts come in to help you make those key decisions. There really isn't a better tool. Like I've mentioned, it is practically impossible to forecast things exactly to the pound, but having that really strong forecast in your arsenal, based on that combination of that historic data and awareness of where you stand in respect of your customer receipts and your costs, how your market is developing, all of those factors, you really couldn't be in a better place to give yourself the absolute best chance to be clear and controlled over your cash. And I just think it's so important that if you are ambitious and you're looking to grow, you're looking at what this actually means for you and what the cash need will be under the different growth paths you're looking to explore. So what I'd like to do now is bring Darren in, who's been waiting patiently. Darren's our head of corporate finance at Nordens and has been working with hundreds of businesses throughout the last year or so, especially given the pandemic and everything else, and helping them find not just finance, but specific finance tailored best for them, because there are a lot of products out there. So one thing I'd first like to touch on, Darren, if you could just give me your thoughts on this. I've heard a lot of people and business owners say to me in the past that having debt in your business is bad, and certain business owners are proud of never having any debt. I'd just like to gauge your thoughts on that, because I know when we've spoken before, you
Yeah, so from dealing with a lot of clients, what it tends to be is that the word debt has quite a negative stigma around it. When people think of taking on sort of money that isn't their own, borrowing, it implies some form of failure or some form of poor performance of some kind. I think if you have that mindset, it is always going to be that. But I often use an analogy with a lot of our clients, which is that, I don't know how many people on the call are homeowners, but I'll ask a client, do they own their own home? And more often it's that they do, and ask them how they feel about it. And most of the time they tell me that, it's an asset, it's success, they're on the property ladder and they feel good about it. But then I ask them if they've got a mortgage and they tell me yes. And I try to explain to them that that's sort of 25, 30, even 35 years worth of debt that they're taking on. But they don't see that as a form of failure. They see it as still a form of success. When I position it that way, it sort of changes their mindset a bit. And I try and kind of loop it back to say, well, if that's the approach you take in your personal life, why would you take a different approach with your business? But borrowing doesn't have to be a form of failure. It can be that you're taking someone else's money or borrowing funding in order to propel you forward to achieve that bigger goal. So when you change your mindset a bit around it, it isn't necessarily a bad thing as long as it's managed correctly.
Yeah, I think that's the thing. I think managing it and forecasting that you've got that affordability is just so key. And I think, that analogy is fantastic, because I remember when you said that to me and it was like, yeah, that really hits home. It's definitely a different way of looking at it. So I'd just like to jump into a quick poll while we're on this subject about just asking, do the people listening in today, do you have debt in your business? That's what we've just been discussing. Do you actually have debt? And obviously these answers will be anonymous. The poll will just show the percentage. So don't be concerned about that. But yeah, do you have some form of debt in your business at the moment? Because like Darren was alluding to, if you don't, there are opportunities to help propel your growth by taking on the right debt finance or the right product for you. So yeah, we'll just see when.
Yeah, I'm just going to close it and share it now.
Okay, so that's quite interesting. So 60% of people on the call listening don't have any debt in their business. So I suppose as we go on, I think maybe we'll be able to uncover that, like Darren's alluded to, that it shouldn't be a reason to stunt your growth. It is a bit of a mindset change, perhaps, for certain people where they believe that, I just want to only pay for what I can afford. But I just think that if it allows you to get where you want to go quicker, it's definitely something to explore. And I just think that you know what it's like. I think if you're really clear on where you want to get to, I think that's so important, because then you are making that decision with some real clear logic behind it about, I've got a vision to get to this level, taking on this debt finance will allow me to get to that level quicker. It makes a lot more sense then. And I think it has to be aligned with being really clear on where you want to get to with your business. And just to touch on one thing, Darren, before I forget, I touched on a project earlier, and businesses that run projects and where they've got multiple people running around doing things and really need to buy things for the business, and they're just a bit scared of sort of what to do to make sure people don't sort of take liberty, so to speak. So what sort of I've heard company credit cards be mentioned as well. What sort of suggestions do you have around that, in terms of allowing people in the business underneath the owners to have an element of autonomy to sort of give them responsibility, but having a cap there to control the debt?
Yeah, without giving them full sort of access to bank accounts and the cash in the business, the options really are to have credit cards. But that's quite a good thing to have. I mean, you could have the traditional credit cards, and apply limits to those cards to individuals, so that each person who has a card can be restricted. Prevents overspending. What it also allows you to do is possibly push the payment for those expenses until you've received money down the line. So if you pay, you pay the statement next month, but you've already received the funds in by then, so you can kind of control the cash a little bit better. The other option you could do is look at possibly a prepaid card, so you can actually allocate the funds already to that individual or that card, and then they can only spend however much has been allocated. So it just gives you that little bit of control over what's being spent and where, rather than giving someone complete free reign of, here's our debit card, and you can spend whatever's in the company bank account. So they're probably the best things for project-based businesses, or where you have people that need to be spending on behalf of the business.
Yeah, no, that makes sense. And we've seen some clients sort of take the leap and use the credit cards, or like you said, probably even safer option as the prepaid cards. So there are a lot of options out there, and are there quite a lot of options out there for those sort of things as well nowadays? So you can kind of shop around and get one that's most suitable.
Yeah. Absolutely, and most of them will now actually link in with anyone's online bookkeeping system. So when things are spent on the card, it will link straight through to the bookkeeping system, making it really easy for the bookkeeper or whoever manages the books to keep track of it. So yeah, there's a lot out there, loads.
Fantastic, and that kind of comes back to what we were talking about before, about you making the most of your technology, getting your bank and cash flow and all your bank statements, everything else, you just automatically link them to your bookkeeping package, like Darren said. And I think if you're not doing that already, we definitely recommend, because it just makes your life so much easier, and it gives you good access to good quality data, which is so important for decision making, like we've mentioned. So drilling down a little bit more, Darren, into the products that are sort of out there for business owners. I know there are loads of different products, but could you just sort of give us an insight into a few different, the kind of the common ones you see? Because I've spoken to quite a few people who just believe that there's just the option of sort of, you've got an overdraft, you've got a loan. It's really as simple as that. But it's obviously, after speaking with you and learning for myself, it's not as clear cut as that. There's a lot more different options out there for business owners nowadays. So yeah, if you could share a few thoughts on that, that'd be great.
Yeah, absolutely. So it sort of depends on the need for the finance. Obviously, there is, like you mentioned, the straightforward term loan that everyone sort of knows. At the moment, we've got the recovery loan scheme, which I'm sure everyone on the call's probably heard about, the new government scheme. There are forms of finance such as invoice finance, where you can get your invoices financed for a period of time to bridge the gap if you have any sort of really bad payers or late payers or poor credit terms. There's merchant cash advance. That's for sort of retail hospitality, where you only pay back the finance in a percentage of what you actually take in. So in the months that you're less busy, you pay less back. In the months you're more busy, you pay more back. That works quite well, whereas so you don't have that sort of fixed financial outlay, especially in hospitality right now. Asset finance, where if you're looking to buy equipment or a vehicle, or computers, IT equipment, you can get that financed. There's various different sort of types of revolving credit facilities, overdraft, credit cards, things like that. And similar with property finance, there's various different types of property finance. To be honest, there's so many different products out there that you could use, but what it's about is identifying what you need the funds for, and then finding the product to fit that. So for example, if you were going to go and buy a vehicle, it would be cheaper to go down the asset finance route because it's designed for purchasing a vehicle or equipment. If you were to go and get a loan to finance that vehicle purchase, you would probably end up paying more interest on that, and it would become more expensive. So if you identify the need for the finance first, that's when you can then find the best product to fit.
Yeah, brilliant. And just to sort of throw it out there, you'd be happy to have a conversation with anyone on the call today who would like to discuss their sort of personal bespoke situation in a bit more detail, because like you said, we're giving the headlines today, but it's very dependent on the business's own situation. And with the invoice discount you mentioned, that's generally quite applicable to the project-based businesses we mentioned, isn't it? Where they perhaps aren't able to negotiate with their customers and have to suffer those 60-day payment terms up front potentially.
Yeah, exactly. Invoice finance is really good right now. I think term loans are quite, they're not thinking bigger picture. It's small-minded. It's thinking, I need money right now and I need to spend it now. Once it's gone, it's gone. Whereas invoice finance allows you to think for the future and finance, collect money in now so that you can invest it now into future projects or bigger projects, and you don't have to worry about being paid by those credit terms from your customers. So that's really good. There's a couple of different types that you can get as well, where one is financing your whole debtor book, if you like. So that's every invoice that you raise, and you can finance everything. But there's also selective. You might say that all my customers are fine apart from this one particular customer who's a nightmare, and then you can just have theirs financed. It would be a more expensive route in terms of interest, so the interest rate, but because you're only financing one customer, the monetary value would work out less. So it's just about finding what fits.
Yeah, exactly. And I suppose the sort of the next follow-on question from that is about, okay, I feel like I'd like to explore my finance options. How do I know if I'm viable? How do I know if I can actually raise finance? I know you've been doing a bit of work with the actual underwriters who underwrite the finance, but can you give any thoughts on that? I do appreciate sort of it is to an extent $1 million question, but can you give any sort of pointers around viability?
It's very difficult. The underwriters don't really tell you exactly how they underwrite, as I'm sure you can imagine. If they told you what they look at and how they underwrite, everyone would meet all the criteria to get the finance to secure it. But they like profitable businesses. They don't like seeing profits reducing year on year. They like balance sheet value to maintain or go up. They don't like to see that falling, and they don't like to see company could be profitable, but they don't like to see all the money being drawn out the business. They like to know that there's sort of debt serviceability in there. But in terms of viability and sort of the lender's appetite, if you like, there's still plenty of finance to be had. I mean, naturally, because of COVID, lenders are a bit more cautious. So there are small things that are affecting applications that weren't previously to stop the finance from going. But yeah, there is still quite a healthy appetite from lenders.
So if a company's profitable, do you have any sort of like ballpark range that they'd be sort of able to borrow? Sort of, I know we're talking sort of hypothetically here, but is it similar to a potentially like a mortgage lending where you can borrow an X amount of your disposable income, so to speak?
Yeah. So what they do is they will look at your last 3 years on average profit. And if you don't have 3 years and you only got 2 years, then they look at that. Or if you only got 1 year, they'll look at that. But they look at the last 3 years, they work out an average, and then they strip back any dividends that have been taken, and then they apply a multiple to it. So it's very similar to how they work out mortgages, and they have these metrics. And what it allows them to do is work out something called debt serviceability. Now that also takes into account debt that's already in the business. So they will factor that in as well. I do actually have like a simple calculator that I've made that I could share with everyone if anyone's interested off the back of this webinar, where you can plug in some figures and it will give you a rough idea of what you could likely take. If it was a term loan, probably isn't great for asset finance or anything like that. But yeah, term loan, it will give you a good indication of what you could borrow.
Yeah, brilliant. Yeah, I mean that would be really useful for those businesses out there that are looking to plan for the future. Actually trying to align that with your forecast to kind of gauge how much you're likely to be able to borrow, because then you can start making your forecast more realistic, like we touched on earlier. So I suppose those are the businesses out there that do have debt. How often should they be looking at refinancing options? What would you say around that? Because I've seen it before where businesses will take, say, for example, a term loan and then just never refinance it or even explore that until the end of the term.
Yeah, at least every year, at the very least. Once a year, you should be looking at your refinance options or your finance options if you don't have finance yet, just to see what's out there and what's available to you. You can do it sooner than that, maybe 6 months. I think any less than that, 3 months if you've got a very expensive piece of finance, 3 months perhaps. But some lenders don't actually allow you to, if you try and reapply with them or look elsewhere, they'll reject it, say that it's too soon since you've looked at finance. So I would say, 6 months, but 12 months at the very least. Things are changing quickly at the moment, so it's good to keep on top of that and just check regularly.
Okay, so I'd like to jump in and finish off with a sort of the final poll for today, and ask the people listening. For those of you that have said that you do have debt in your business, how often do you look at refinancing this? Is it every 6 months? Is it yearly? Or is it longer? Or do you simply do not explore refinancing options at all, but you have debt in your business, but you just never really considered it, never really looked at it?
Okay, about 30% have responded so far, so we'll just give it a few more seconds to get a few more responses in.
And I suppose this won't obviously apply for the people on the call that don't have debt in their business. So there'll probably be less people answering this one, I guess. But it would just be good to gauge how frequently you're thinking about refinancing. Because like Darren said, once a year, really, you need to be. Okay, so bi-yearly. Okay, so a few people, 33% have said they do it more than once a year. So maybe perhaps there is an opportunity there to perhaps lock in a bit more reasonably placed finance and just keep abreast of the options that are out there. Like Darren mentioned, things are often changing. So, and those of you that do have debt but don't explore refinancing options, again, you may be costing yourself interest, you may be costing yourself a better deal. So I think it's something to maybe add to Arsenal going forward with that.
It's not just that. Sorry, Joe. It's not just that as well with the interest, the sort of cost of it. It's also the fact that you might actually be able to borrow more and you need it, but you don't even realise because you haven't explored those options. So definitely look at that.
Yeah, good point. So thanks for that, Darren. Like I said, if anyone listening would like to speak to Darren directly about their specific situation, because everyone will be different, it will be quite bespoke and unique to your own personal circumstances, your own business circumstances. Darren will be happy to have a chat with you. But I think that covers sort of the content for today. I do appreciate when we are time bound slightly, but I'd like to open the floor for some questions, because as we've got Darren on here, I think it'd be good for anyone who has any questions to fire away, and Darren will do his best to help give you some advice and guidance.
Thanks, Joe. There's been a few questions that have come in while you've been talking. So obviously they came in throughout the session. So I'm just going to answer some of them in order, if that's all right. Ask them in order even. So the first one was, I've never done a cash flow forecast before, and they're looking for sort of top tips. Where do they start?
Okay, so we can, like I said, we can provide you with a template to help you, and we would also be happy to review it with you after and give you some sort of advice on how you could possibly maybe improve it or add in those scenarios that we talked about to help you with your decision making. So we'd be happy to do that. But I think it's just, if you've never done one and you now appreciate the need to do one, I think you've already done the hard part from a mindset point of view. Taking it to the next level is just jumping in and having a go at it. It can't be any worse than where you are now if you've not got one. So I think start as you go on, and you'll learn from it quite quickly as well. I think that's the we do these with clients. It becomes a real precious tool in their arsenal straight away, very quickly, and they don't lose sight of it. But just over that hump of initially believing that it is important and it can actually help you is really important.
Great, thanks, Joe. The next one sort of follows on a little bit. So I need to make my credit control function more systemized and streamlined. Do you have any advice on the best way to do this?
Okay, so this is quite an interesting one, and like I said, we'll touch on systems and processes a little bit more in, I think it's 2 weeks' time when we come to that section. But right now, in terms of your credit control function, things I'd be suggesting are look at the way that you're set up from a bookkeeping perspective, first things first, and look at related apps that you can easily use to automate some of the chasing. Depending on your bookkeeping system, like Darren mentioned earlier, you can actually set auto chasers. which are really helpful because it stops you having to send emails. It will literally do it automatically. And for anything else, it's sort of a case of documenting that process step by step. So sit there and think, what are the steps we take to make our credit control function run smoothly? Document it step by step. Ideally, like I mentioned, a team member if possible, so they can buy into that way of working. Or ideally, get them to document it as you're discussing, so it then becomes their sort of project. And if you're able to delegate that responsibility to them, it sort of becomes their baby. And they're much more likely to buy into it and therefore follow it and encourage others to follow it. So I think that's a fundamental of all systems. But I think right now, I think it's a case of looking at the apps and the technology that you've got to use at your disposal, because like Darren mentioned, so many of them these days filter in and align with your bookkeeping package, and you can get a lot of the stuff you're doing manually or that's taking up your time to actually be completely removed and done automatically.
Yeah, so just while we're sort of talking about credit control and cash flow, there's another question that sort of relates to that. So if you're just starting a business, at what point should you create a cash flow forecast?
That's a really good question. And I think you should be literally, as soon as you're starting your business, you should have that cash flow forecast. I think it should be one of the first things you do. And if you can do it early doors like that, when you're starting your business out, you're going to be a step ahead of so many other businesses, especially startups that aren't doing this and will encounter problems. Because what the cash flow forecast affects, despite your profitability forecast, it allows you to foresee those pitfalls in advance that you're likely to face, and then you can make good quality decisions around them. If you don't do that, you're sort of running blind, and you could then, an issue that you could have made a small hiccup will then turn into a massive hole, and it might be very difficult to get out of it. So simple answer to the question is, do your cash flow forecast as early as you possibly can, and you'll remain a step ahead of those that aren't.
That's great, thanks, Joe. So I think I've got a couple now for Darren, probably. So the first one is, how do you feel the lending market will change as we start moving away from COVID-19? So you mentioned some of the different sort of schemes available now, but what else do you think is going to change?
I think lenders are trying to get back to normal as soon as possible. They don't like these schemes. It's not very good for business for them. So they're going to try and move away from that and get back to normality. It's most likely going to be looking at secured debt as well. With the CBIL scheme, the bounce back loan scheme, what's happened is there's a lot of unsecured debt. If you took under a certain amount, then there was no security, no personal guarantee, no anything. So they're going to try and look to fill their books up now with secured debt, right? So they're going to want to take either personal guarantees, or they're going to want to probably take a charge on property. So we're going to see a lot of that. Credit scores are meaning a lot more now. It used to be that you needed a good credit score to acquire finance, but you could get around it with a slightly poor credit score. I'm now seeing a lot of knockbacks and a lot of rejections purely based on the credit score. So I think they're going to bring that in as a more important metric into their underwriting process. There also seems to be, and I think it's going to get worse, a reduced appetite for struggling businesses that need cash. They're cautious, they're scared, so they're not going to want to see a business that's had poor performance and now they need cash. It's just not good for business, and that's essentially what these lenders are trying to. That's what they are, right? They're a business. They're looking to make money too. But yeah, they're going to try and move away from these schemes and just get back to normal as quickly as possible. Yeah,
great. So another one was around, they've been told that they have forms of finance available to them, but they're putting it off as they don't really know what to use it for. Should they take the leap and acquire it anyway? I mean, is it worth just having cash in the bank, even if you don't know what to spend it on yet?
In my opinion, no. I wouldn't encourage taking on finance for the sake of taking on finance. It's going to cost you money for no reason, unless you can get it interest free. But yeah, I think it's a recipe for disaster, because you end up paying interest, or you end up spending it on something you don't actually need to be spending it on, and then it's not going to drive you in the direction you need to be going. I would look at like what Joe was saying earlier. The first thing is best to carry out a forecast. Firstly, identify, do you need finance, yes or no? That's going to be the first thing. There's no point, like I said, there's no point paying for something that you don't need. So do you need it? Secondly, if you do need it, when are you going to need it? It's, if you get to a point where you're already in that deficit, it's too late. You need to be in a position where you can foresee that need for finance and you acquire it beforehand, so you're ready. So that'll be the second thing. And then the third thing is going to be how much do you need, right? You don't want to take too much and pay interest on that. You also don't want to have too little where it hasn't really solved your problem. So forecasting in this area is going to be the best thing for you. Forecast, find out what you need, why you need it, how much you need, when, all these things, and then you'll really be in a good position to take finance if that's the right decision.
Yeah, somebody's sort of added that they took a Stables loan sort of during the COVID pandemic, but haven't used it. Do you think they should keep it, or should they repay it?
I mean, you've got the money in the bank; it's sitting there; it's not paying any interest. If you get to, well, this is the thing. I would do a forecast, look at revisit your goals for you and your business. Are you sitting on the money that you could actually invest it into something that's going to propel you forward to your goals? And if it is, put a forecast in place, see what you're going to need and when you're going to need it, and you could make use of that money. If you've done that and it turns out that the money isn't needed and it is just sitting there, then I wouldn't hang on to it. You'll be paying interest on something that you don't need. So yeah, I would never recommend that. Don't take finance just for the sake of taking finance. It's a dangerous, slippery slope.
Yep. So the last one is, if my business is achieving success and cash flow is positive, do I still need to have a cash flow forecast?
Yeah, I mean, I think that would be able to add a little bit from an actual lender's perspective and whether they look at forecasts. But I think, yeah, I mean, from our point of view, I think, yeah, I would still look at doing some forecasting and financial modelling, whether you're doing well or not. It's very, very easy to get complacent in the good times. You've seen it too often. Darren will say exactly the same thing, I'm sure, where little cracks in the good times can become gaping holes as the good times start eroding a little bit. So your forecast, like we've said, enable you to set those targets so you can spot issues well before they come to that critical stage. So I think it's just as essential, even in the good times, to be really on top of these things. Darren, I don't know if you just want to expand from a lender's outlook of whether they want to see forecasts and things like that to see that the people they're giving money to, especially at a high level, are actually on top of their reporting.
It varies. Small finance, and let's say your term loans, very rarely are they going to want to see that sort of information. Large sums of money or specific type of finance, maybe you're looking to build a property, then you need a development loan. They're going to want to see forecasts. But when you get to a certain size facility, yeah, they want to make sure that you forecasted how you're going to pay them back. Definitely.
That's brilliant. So I think just the time, we'll probably move forward now. Anybody whose questions we didn't get to, we'll pass those details on to the team at Nordens and they'll reach out to you. So hopefully you found the session really useful today and you've taken lots of notes. As we mentioned, this is the fourth one of the series of 7. Obviously, Joe and Darren have talked about their interactive accelerator program that covers this in a bit more detail. So in order for anybody who's interested in it, I'm just going to do a quick poll so that we can share your details with the team at Nordens if you want to find out more about that program. So on your screen, very simply, if you'd like to find out more, please click yes, and if no, tick no, and then we'll share your details with the team at Nordens and they can reach out to you to tell you a bit more information about their program and how they can help. Okay, most of you have voted, so thank you for that. We'll share your details with the team. So we've also got the rest of the webinars due to come up over the next couple of weeks. So the next one is Systems and Processes on the 19th of May, Profitability on the 26th of May, and Team and Culture on the 2nd of June. Just a very quick poll just out of interest. Have you signed up for these webinars? So yes, no, and no, but I'm going to. That's great. So I'm just going to share that because most of you said yes, or you're going to. So it'd be great to see you at those next webinars as well. Make sure you bring your notebooks with you. And then there's just a couple of other webinars we're running in May as well. Those of you who have attended our webinars before know we've got quite a robust webinar program at the moment. So these are more obviously HR related. So how to deal with bullying, harassment, which is tomorrow, and then coronavirus returning to work after lockdown. So that's covered sort of HR aspects as well as the health and safety aspects of bringing employees back to work. Just a reminder, we do have a newsletter. So anybody who's not signed up to our news, if you would like to make sure you get our news in your inbox, please do so. There will be a link that we send out following this webinar as well to make it easy for you. And anybody who didn't have the questions answered today, if you want to share those with us, either we'll pick them up from the Q&A poll that came through, but anyone else, if you email inquiries at hrsolutions-uk.com, and we'll make sure that Joe and Darren get those questions for you as well. As always, there will be a poll that comes out afterwards on the email asking for your feedback on the webinar, particularly about these webinars, but also any future webinars you'd like to have us run as well. That just leaves me to thank Joe and Darren for this week's webinar on cash flow. I think it's been really insightful, and hopefully everyone's found it really useful. And we look forward to seeing everyone else on next week's webinar.
Thanks, Greg. Thank you. See you next week.